From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for Friday, November 15th, 2024. Taking a look at the calendar, our Milwaukee Bucks are in Charlotte for a Saturday afternoon game and back at the Forum with Houston on Monday. And the Marquette Golden Eagles are home on Sunday afternoon with Seton Hall. Now, for something a bit different, on Saturday, dining with divas at Hamburger Mary's sounds absolutely delectable. And for a good laugh, comedian Wanda Sykes is at the Riverside Theater Sunday night. Okay, here we go. Usually, New Hampshire makes the news because they're first in the nation to vote in a presidential election. But this time they made the news because a single fisherman hauled in a 1,000-pound bluefin tuna all by himself. The trouble is, he's a fisherman, so who's going to believe him? Car rental company Hertz is no stranger to the headlines. You may have heard about them charging customers for neglecting to fill the gas tank before returning their electric rental car, or for having customers arrested for car theft after returning the car. Now, one manager seems to have a bit of a different understanding of the word unlimited than most of us do. A customer was charged $10,000 and threatened with arrest for driving too many miles in a car that was rented with unlimited miles. The company has reversed course and has stated that they do actually understand what the word unlimited means, for now. Russian state media has congratulated Melania Trump on her husband's re-election. They did so in a rather unique way, though. They showed nude photographs of the First Lady-elect on live television. And we think American media is bad. And our funny headline of the week, The Onion to buy InfoWars. And no, that headline did not come from The Onion. At the big table today, we have, and all fully clothed, thankfully, Kendall Bauer, Dave Sandstrom, Joel Driesing, and here's Kyle Tedding.
Well, thanks, Jason. What an open recording this podcast a bit early, so we'll have closing numbers in the show notes for the podcast on our website. Happy to have you go there to see the closing numbers for the market. But recording on a Thursday afternoon and still plenty to talk about as we come through now week 2, post-election. A lot of, I think, economic news in focus this week as we look to what that means for, in particular, the Fed looking ahead. Joel, we had both consumer price index and producer price index come out this week, Wednesday and Thursday, and I think maybe two of the more important indicators. We like to put a lot on politics, but I think more than anything right now it's earnings and interest rates, and nothing impacts interest rates maybe more than the direction for inflation.
Right, and both of those show that inflation is still lower than it was a couple of years ago, but both of those also showed that taming inflation is a bumpy ride. The consumer price index, which is the broadest measure of inflation, was up 2.6% from a year ago, and that's up a bit from 2.4% in September. But remember, as recently as June of 2022, that number was 7.2%, and the Fed, increased interest rates to try to restrain the economy a little bit so that inflation would come down. And beginning in September, it sort of said, well, we think we've gotten inflation about to where we want it, so we'll start easing up on the interest rates. And they cut in September, and they cut again last week, and now there's speculation as to what they do in December.
Yeah, Dave, we've got a Federal Reserve chair that seems to be on the hot seat for a variety of reasons, not the least of which what happens with inflation going forward, as the little bit of an uptick that we've seen recently is some of the hotter than maybe expected prices. The trend, are policy changes maybe going to support a little higher inflation still down the road, or can Powell and the Fed really continue to back off? We got news this week from Powell that maybe he's not quite as eager to cut rates given the uncertainty now about inflation as maybe we were 6 months or a year ago.
I think you're in the difficult phase of monetary policy now. it's fairly easy to make a decision to aggressively raise rates when inflation's at 9%. It doesn't take, you get a lot of support from the rest of the Fed committees. It gets a little tougher, though, when you think you are on that kind of the tipping point, right, of, okay, when have we raised enough? Where is inflation at? Are we hitting our target? And how aggressively now do we go down? So that's kind of the phase we're at right now. So far, I think inflation has reacted pretty well to the measures that they've taken. And while it appears to be fairly stubborn right now to get to that 2% number, I still don't think we're in jeopardy of returning to 9% in the near term. So I think they've conquered the what you might even term a disastrous inflationary environment when you're approaching double digits. But it is going to be a little trickier now, Kyle, as you mentioned, getting us to that target. How fast does the Fed continue cutting? I think this is going to be that point in time where markets are going to get a little jumpy.
And Chair Powell actually said last week when he was announcing the rate cuts, he said, we're not declaring victory. So he's not there yet. I think he's just continuing to be cautious. And that's what we're hearing when he's saying, we're going to have to look and see as far as December is concerned. And he keeps saying all along, let's keep looking at the data. And Dave, I just wanted to correct myself. It was at 9% at one point and not 7%. I was actually thinking of the other number that the Fed actually likes to look at even more than the CPI, and that's the Personal Consumption Expenditure Index, and that went up to 7% in the same time 2 years ago. And that's actually down at 2.1%, and that's very close to the Fed the Fed target of 2%.
And I think we shouldn't forget that much of what the Fed is doing is posturing, right? Much of what they're doing is setting the tone for this is what we care about, this is what we're watching, and we're going to be tough on inflation because we can afford to be, because unemployment isn't a problem, because we aren't seeing the kinds of foundational cracks in the economy that might lead us to have to cut. And so we get to talk a big game, we get to talk tough, even if it means that we don't quite have to back it up. The hope is they don't have to back it up, right? The hope is they don't have to say, well, we're not going to cut rates for a while now because inflation is creeping higher. The hope is that the very thought of, well, maybe the Fed isn't going to move quite as quick keeps a little bit of a damper on that number. And so I think that's part of what we're seeing now as well is, all right, talk a big game and hope you don't actually have to play it.
I think one of the things that maybe the elephant in the room is the percentage of that inflation number that's attributed to housing. That continues to be the very stubborn thing for the Fed. They've made some pretty sizable moves in a lot of other areas on the downward trend, but housing is very sticky. And that's one of those things that, unfortunately could surprise to the upside if you ease too quickly on rates and the mortgage activity picks up again and housing picks up again on the activity side. I mean, that could push you in the wrong direction. So I think they are spending a lot of time evaluating the housing market right now to see where that is going to move, because I think that's a big, big piece of it.
Well, and Kendall, good news, bad news on that front, right, is maybe we've seen some easing on the overnight rates, but longer rates have stayed somewhat high, in fact, moving higher in a lot of places to normalize the yield curve. So you've got now maybe some short-term borrowing costs that have come down, but mortgage rates haven't come down maybe as much as some people had hoped so far.
Yeah, and we talked about that the past couple of days as to maybe speculating as what's driving it. I think an interesting point might be that, prior to the election, you saw the 10-year drop. I don't recall exactly, maybe down to high threes over the summertime. Some of that potentially being a bit of a hedge, with the election. And so seeing the 10-year, Treasury rise could be just some of that unwinding, right? People saying, okay, maybe things aren't as disastrous and looking for more opportunity. Remember, too, yields rising, typically a result of liquidation or selling in the bond market.
I think it's all about earnings and interest rates. It's tough sometimes in the midst of the news cycle that feels like it is constantly trying to put some headline to here's what's driving markets today. But we came through a pretty strong earnings season for third quarter. We've seen interest rates that are a little more supportive today than they were at the start of the year of higher stock prices. And as a result, we've seen stocks rise. And then I start to see headlines, Dave, about is this stock market rally tired? Or is this the beginning of the Santa Claus rally? Is this the Trump trade? What ultimately is driving this? And I think, sometimes maybe those headlines miss the bigger point, which is underlying the rally the last couple of years has been some fairly strong fundamentals.
And I think that it's easy to get caught up in election promises and current events as it relates to where the stock market is. And I think sometimes investors put too much stock in what happened yesterday for where stock prices are, when really what that stock market is doing is looking out into the future, and it's trying to price in those future earnings of those corporations. And to your point, Kyle, we have some very attractive and optimistic earnings numbers, I believe, for next year. Joel, you can correct me on this if I'm wrong, but we're right now the consensus is somewhere in that 15% range for an increase for calendar year 25. And the market is definitely at this point of the year, late in the year, has got a big chunk of that, I believe, is priced in. So that is, I believe, what is pushing these valuations to the levels that they're at, is the expectation of those future earnings is quite strong.
Well, and again, we can't say it enough, nor have we said it enough, that if it is earnings and interest rates, ultimately, those earnings come from stronger consumers, stronger spending, all the foundations of what's been built, not just this year, last year, but really the post-COVID economy leading up to this, that's been a slow burn back to where we were supposed to have been all along. And so I think when you kind of look at how do we support stocks at their currently elevated valuations, yeah, stocks certainly look a little expensive relative to history. Well, a reminder that history looks nothing like where we are today, that the companies that made up the S&P 5, 10, 20 years ago were first and foremost much more manufacturing driven. Manufacturers aren't as able to move sales to the bottom line because they're not as profitable a business as the businesses that make up the S&P today. And so if what we're doing is trying to say, well, maybe the economy doesn't grow quite as fast as we hoped, and that might mean that maybe we shouldn't pay quite as much for stocks. Well, maybe the economy in aggregate doesn't, but the businesses that make up the S&P, the best and brightest, the greatest businesses we have, maybe they are going to grow a little better than average. Maybe the profit margins in those businesses look a little more attractive. And so I think you got to look beyond those historical comparisons right now. I think stocks still look a little expensive even relative to that more rosy outlook. But I think to your point, Dave, that earnings growth looking ahead to 2025 is one reason why I'm pretty optimistic that you don't just have to give it back because stocks look a little expensive.
And I think maybe it's a mix of both things, right? Could stocks be getting tired and happy, with the election results? I think you could make a case. Yeah, exactly all the things you just pointed out. You could argue, too, that potential more favorable tax rates for corporations could be driving a short-term rally. And then on the opposite, let's be honest, we are getting into a period in time in which markets are probably due for a pullback. We look historically every 12 to 18 months. It's not uncommon to see stocks pull back about 10%. Last time that happened was October, if I'm not mistaken, of last year. So, maybe once again, rather than one thing being the answer versus the other, maybe it's a bit of both things. And I think now as we approach the end of the year, probably as good a time as any to start thinking about things like RMDs and gifting and maybe taking a peek at your stock allocation. And if it's risen, because things have done so well, as you pointed out, maybe now isn't the worst time to take some chips off the table.
No, I think that makes some sense. And it's funny, I was driving in this morning to work and listening to whatever radio station wasn't on commercials and stopped on one of the local NPRs. And they were talking about how the crypto industry had spent more money in this election cycle than any other single industry. So I get in and I'm trying to put some number to that, right? Because it's one thing to make the statement. It's another to really try to wrap your arms around the magnitude of that. And then seeing numbers anywhere from 130 to 300 plus million that was spent just on that regulation. And it really struck because now I'm getting a lot of questions about, well, should I be thinking more about Bitcoin now that it's run so much? Should I be thinking more about crypto more broadly. And I think the easy answer historically had always been, there's a lot of great technology there. There's a lot of great kind of underlying opportunity, but maybe you don't have to buy that crypto asset as the way to participate. Go ahead and buy the payment processor, right? Buy the Visas and the MasterCards of the world, because they're going to benefit from more efficient payment processing. Buy the retailers whose cost to carry that card machine is going to go from 2.5% or 3% a transaction down to 1.5%, because Visa and MasterCard can do it cheaper. And then I watch Bitcoin run higher and I look at, okay, well, if we spent that much money on crypto, is it an opportunity for investors, Dave? And I know this is a question you get quite a bit, and you and I have talked about it. I love kind of the way you approach that idea. What are you telling clients that want to ask that question, which I think right now has been such a question motivated by the kind of current political landscape?
Kyle, we're in the business of evaluating businesses, assets, other securities, and we use fundamentals, earnings, interest rates, cash flow, price to book. There's lots of things for a business or any other type of income generating asset where we can make that analysis and then try to make an educated decision. Cryptocurrency doesn't offer us that. It's almost a greater fool theory in play here, where the only way you make more money is you can find somebody else to pay you more for it than you did. And on any given day, you've seen some significant price swings in this asset class. Over the years, we've seen just some very, very traumatic drops. And I would think that amateur investors that get into that don't have the stomach for that, and likely are the ones that have paid the price. So I would say that, and this is a comment you made earlier, I think you need to separate investments like that into more of a gambling category, entertainment category. And if you want to invest in something like that or put some money into that class, keep it separate from what your retirement plan is and really what your lifetime goals are for your investments.
Yeah, I think the fun part for me about that conversation is watching just how much the value of a Bitcoin has moved up. And, the occasional pushback of, well, you told me not to do this. Well, I think the answer when I get that question is, well, it's not that we told you not to do it. It's that we told you we don't know how to value this. Is 90,000 the right number, or is 90 the right number? Is it even that? Because there isn't a methodology to say, here's worth. The way that I can look at a bond and say, well, I can tell you the precise cash flows of this bond from now until it matures, and based on the current rate environment, here's what you should pay for it. And I can look at a stock and say, well, here's the expected cash flow from that stock, and here's what I have to discount that cash flow by, some reasonable rate of interest. So here's what I'd be willing to pay today for that next 10, 15, 20 years of return into the future. I don't know how we do that, to your point, Dave, with cryptocurrency right now. There may be a point in time down the road in which you can come up with some valuation metric, whether it's looking at transactions conducted in that cryptocurrency or whether it's just looking at a market that is much more stable than the one we have today. But until we get there, to your point, I think it's more of a gamble than it is an investment, because investing is more about value, right? How do we ascribe some value, and what are we willing to pay? And for Bitcoin, I just don't know what that is. And so my answer has always been, I don't have any problem with a small piece of a portfolio being in that cryptocurrency, but I do consider it a gamble. And there's a line in The Sopranos TV series, HBO TV series, about betting with your head, not over it. And the simple thinking is only put into it what you can stomach losing, because odds are you're going to lose it. The house normally wins. The problem, I think, with crypto is we maybe don't quite know who the house is yet. But if you don't know who it is, it's probably not you. And so I think that's my concern more than anything, is if it's something you want to do, I'm not here to tell you don't do it. I'm here to tell you it's really hard for me to make the investment case for that. With that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.